Yeah.
Wow.
We've been looking forward to this one for a while, right?
Yeah, we've been kind of like even like since August, we've been talking about quarter three looks really good.
Yeah.
And we finally got the numbers, and it is good. We saw a 4.9% GDP growth in quarter three,
Yeah.
which is honestly just blockbuster numbers. I mean, it really is. The month before, the quarter before was 2%. The quarter before that was around 2%. The quarter before that was around 2.3%. Now up to 4.9% growth. That's just banging.
Yeah, it's huge.
It's
huge.
Most of the growth is from the service sector, then non-durable and durable goods. But what I'm really excited about here is the GDP breakdown, right? So GDP is made up of spending, imports minus your exports, your private investments, government spending. Okay, that's what makes up GDP. We saw government spending make up 0.8% of the overall 4.9%, right? So 0.8% was because of government spending, 0.7% was because of exports, 1.3% was because of investments, which is awesome. And then banging is 2.7, which is because of consumer spending, which means people have the money and they have the capacity to put money back into the economy, which is really, really awesome to see. I have reasons to believe that might not last.
I agree.
But there is really good news coming out of here. And before I get to the bad news, I just want to talk about how this relates to the rest of the world. Okay, because there is some bad news, and we'll get to that. But I want to talk about how this relates to everything else. So let's compare to what happened in the EU in financial quarter three. The European Union GDP fell 0.1%. So while the United States is growing at 5%, Europe contracted 0.1%. Now, some nations grew. France grew 0.1%, Spain 0.3%, Belgium 0.5%, but Germany, Austria, Portugal, Ireland, Estonia, Lithuania, a bunch of others contracted. And it's just crazy to me that the West is on two separate economic realities right now. Two very separate economic realities. China, what are you going to say?
Well, I guess this goes into the bigger picture of the consumer spending in the U.S. There was recently an announcement that for the first time the EU has paused its interest rates rising. So the way I'm seeing this is consumer spending is up in the U.S. because people are more confident in the economy. We've had rates paused for a while, right? They're a little bit less scared about a recession. They're a little bit more confident in us hitting that soft landing. And at this point, real wages have increased in the past year, 2 years, whatever it is, right? Real wages are not down, which means wages are outpacing inflation.
That's right.
So I think that is something that could explain why the U.S. consumer spending is up over what they have in Europe, where it does still feel shakier.
Right. And that's important to remember, right? We have that real wage increase. Our wages have outpaced inflation over the last year, which is really, really good. But the issue is people haven't felt it. And that's what's a problem, because people still, when they respond to surveys, they say the economy sucks. They say we trust Trump with the economy more than Biden. And it's because consumers they're waiting for prices to come back down, but that doesn't happen. Prices don't go back down. They just stop growing as fast. It's very, very volatile prices that go up and down, up and down, up and down, like oil and food. Most of the time they just go up, and it's about, okay, how fast are they going up? It's very, very, because you have to think about all the input prices that go into each product. All of those things add up to the good.
Well, and just the manufacturers, the producers don't want to lower prices. Once they've seen that they can sell something at a certain price, they're just going to leave it there, right? And when they can, they're going to increase it.
Right. They're going to raise their prices as much as the market will allow them to raise it without getting massive pushback or a decline in sales, right? So now in China, their GDP grew at 4.9% in quarter three, which is insane to me that I'm sitting here and I'm saying the United States and China are growing at the same rate.
See, you spin that positively, which it is positive.
Yeah.
Because of how long China's growth has outpaced the United States. But I read that and I am shocked But they are still growing that fast.
It's shocking because we've talked about some of their economic calamities here where their exports have fallen, their imports have fallen.
The
and
real
even
estate market is collapsing.
And despite all that, they're still growing at 5%.
It's insane to me. And I wonder about the data. Like it's so crazy. Like I don't understand.
I know.
That I wonder how realistic this data can actually be.
I think it's just important to put China in context then, because like they have a 5% growth target for the year. Mm-hmm. So by quarter 4, they want to hit 5%. And to do that, and so in that number, putting that number in context, that is the lowest Chinese target ever. That's the lowest target they've ever even asked to hit.
Really?
That's the lowest they've ever attempted to hit.
Wow.
So 5% for China is definitely minuscule growth compared to the U.S. because, you can imagine it's harder to go from, it's harder to go from 20 to 21 than it is from 1 to 3. You know what I mean? But there are some, and China's growth of 4.9% actually exceeded expectations. Economists projected that it would grow at 4.6%. So China has exceeded expectations in that regard. But there is the Purchasing Managers Index review of October, which is a very important metric, which gives a glimpse into the economic trends before they reflect into economic data. So when the Purchasing Manufacturer Index is this very, very large-scale survey that goes out to numerous business leaders, to inventory holders, to capital investors, and it basically gauges their interest in investing, their interest in purchasing, their interest in expanding. And their index, the PMI, came in at 4.5% this month. It was forecasted to be around 50.2, which means that there was a reduction in what they expected, and there was a reduction in the month over month. Now, the Chinese PMI index has had a little bit of trouble in recent months. In April, it was extremely negative at had negative 5.2% change, falling to 49.2. It rose slightly over the last few months, but October it dropped significantly. Now, what this means is there is genuine fear that there is trouble on the horizon in the Chinese economy by the industry leaders inside of China that are the ones interacting with the economy every day. The United States has its own PMI index, and the United States PMI index is currently at 49. Now you'd say, why? Okay, that's also really bad. We just talked about how China was at 49 and we 49.5, and that's bad. So is the US being at 49 bad? Well, kind of, sort of, because the United States started off at the year at 48.4 PMI. Now we're at 49. So as of year to date, we are seeing a rise in our PMI index, which means that industry leaders are seeing things to be hopeful for in the US economy. It's all about that slope. So this is a really interesting thing that I want to obviously keep following month over month now. And it's just exciting to see the US kind of be the top dog on the economic side that we haven't really seen in a while.
Yeah.
I
agree.
It's really interesting. But now there is some bad news, and let's get to that. So the savings rate has dropped to 3.8% from 5.2% in the last quarter. So we are approaching some of the lowest saving rates that we've had in a very long time. We're approaching saving rates that we had in 2008, which is really, really bad. We do not like to see that. That means that people are consuming more. So when we see that number, right, savings rates falling, that makes a lot of sense as to why our consumer spending was so high, because people are spending the cash that they had on reserves.
Yeah.
Now, in addition to this, we also see a rise in credit card delinquencies. We have credit card delinquencies rising to 2.8% of people with credit cards facing some type of delinquency in the last 30 days.
Yeah.
And so are people overspending?
I think so. And that's why it almost confuses me. I don't know why they're so confident.
I know.
These obviously are, like, we just got these great economic numbers. We just talked in our last episode about how every month the jobs report comes out and it's like, wow, this is fantastic.
Every single time.
So maybe that's it. It also is hard for me to believe that the populace at large is so plugged into those overall numbers and like takes it really into account in their personal behavior.
Yeah.
So I don't know. I tried to dig to see like what this consumer spending is on. I couldn't find it itemized. So I'm hesitant to try to explain or deduce like what this is all going to.
Yeah.
But in general, the fact that people are willing to be draining their savings
Right.
just to spend right now.
Right. And I will say the credit card delinquencies are kind of almost look like they're adjusting towards like the mean of what credit card delinquencies are normally.
Yes.
So like throughout the 1990s and the early 2000s, credit card delinquencies hovered around 4%. So the fact that we're at 2.9% doesn't necessarily mean we're headed to really bad economic times. It might just mean that we're reverting towards the mean. It might mean that because interest rates have increased to historic highs right now people are having more and more trouble meeting their minimum monthly payments, which makes sense with higher interest rates, right?
Yes.
But that also will eventually lead to less consumption because people are going to have less liquidity.
Yeah, definitely. I wonder, do you think part of this, or I guess that it's probably too late for this to come to effect, but the resuming of student loan payments?
Yes, it's awesome that you mentioned that because in the Bloomberg's article where I was reading, they talked about how the student loan payment will actually reduce consumer spending in the next quarter by 0.3 points alone.
Yeah.
So just the resumption.
I don't know if that's a word.
I like it.
Okay.
Let's make it.
Sure.
Just the resumption of student loan payments will reduce consumer spending by 0.3%, which is pretty wild.
Yeah.
Right? That's a lot of consuming power that's just going to leave the economy. Now, is our economy ready for that? That's a really good question.
Yeah.
Because a lot of money is going to be going towards a non-productive fund here.
Sure.
Right?
I think it's okay.
Right.
Like, I think we're just going to drop back down closer to a 2% quarter. That's what I imagine.
Yeah.
Maybe a 1%.
Maybe in worst case scenario, but I think I kind of agree with you there.
Yeah.
I do think it's interesting to watch the credit card delinquency rates because it's interesting because right after 2010, you see a massive decline in credit card delinquencies, and that is perfectly clearly in relation to the dropping of interest rates.
Yeah.
Right? That's when quantitative easing was at its full force, and it's like an exponential decline until 2016. And then when interest rates rise, it goes up again. So that's a really interesting thing that we noticed there.